Welcome everyone. Today we are going to look at the financial ratios, the second part. Last time we saw the growth ratios and profitability ratios. So a disclaimer that this stock market information is for educational purpose. I am not a SEBI registered advisor. Consult your financial advisor before taking any buy, sell, hold any decisions on investments. We are not liable for any gains or losses made by you. The objective of this course is to spread financial literacy. So we have done this last time, growth and profitability ratios. Now we are doing this part today, the yellow band. That is, we'll be looking at the leverage ratios, the debt related ratios, and the performance related efficiency activity ratios. And next time we'll be seeing the valuation ratios. So yellow band, what we'll be doing today, the leverage, debt related ratios and efficiency ratios. This is just for a recap. This is how the markets are defined: micro cap, small cap, mid cap, large cap, and some people refer mega cap above 1 lakh crores. Market cap definition is number of outstanding shares into the price of the stock. This is the screener which somebody asked me last time, and I'm just kept this screener page. This is what you can use it for your growth and profitability ratios. You can screen that. Market cap will vary depending upon what you want to keep. So you can use these definitions for your market cap. And this will vary, the first two lines will vary depending upon what you want. Here I have taken only mid caps, so it is between 50,000, between 5,000 and less than 20,000. Volume is important because it helps you to understand how much trading is happening on that stock. Because if the stock is not having good liquidity, so anything above 1 lakh, 2 lakh, 3 lakhs is good. Less than 1 lakh or less than 3 lakhs, you can consider it not a very liquid stock, because kabhi liquid nahi hone se, it is difficult to sell in the market also. Nobody is there to buy your stock. Sales growth, you can consider for 5 years, profit growth for 5 or 3 years. Okay. Return on equity, 20, 15, whatever way you want. ROC, you can have a look at for 3 years or for 5 years. And then it should be above 15, 17. Peter Welch says that 17 is a good figure to look at. ROE over 3 years. And net profit margin should be 10-15% minimum. If the measures is doing profits less than 10%, then it is not good enough. So today we are looking at some 2-3 ratios: leverage ratios, management efficiency, and operating efficiency. Now leverage is nothing but I am having a limited capital. I want to invest and expand. So how do I control that? How do I use that? If you know, if I have to move a heavy stone, then I use a lever in physics and I put some kind of a middle point or at that level, and then I try to pull it up. Earlier days, if you must have seen the road industry, people used to use levers. So leverage is not bad. Everything you cannot do it on your own. And you should not be doing it. You have to take loans. You have to take debts. So how well you use your debt, your borrowed capital, is an important part of every business. Because that debt should be such that one thing you are able to pay back. Second thing, you are able to use it in a better way. So how the company is able to meet the short-term and the long-term debts is what we are going to see in your leverages. A company which is highly leveraged, like currently Tata Steel is still highly leveraged, but it is reducing its debts. But if the company is having equity, then, and it is able to pay the loans from its cash flow, then that is not much of a problem. But if it is not able to pay it, then it becomes a problem. Leverage will improve your ROE values, ROCE values, but it has to be used effectively. Leverage used by investors by doing FNO trading, by doing margin trading. So you're having investment of 10 lakhs, 5 lakhs, and you are doing trading of 50 lakhs plus. All this is happening by investors. I, for one, don't like this, and I am away from it because at my age, I feel that it is not. You can easily lose your money. I know many people who actually do well 4 5 times, and then one bad day they finish their whole earnings of the month in 1 or 2 bad days. So you have to be very careful. And when the volatility is very high, then you're stuck up with some of the problems. You lose a lot of money also. Solvency ratio tells me also, or leverage ratios tells me how well my company is able to see its long-term liabilities. It tells me about my company's financial health. It tells me whether the cash flows are good enough to meet the long-term liabilities. The money should come so that the money is able to take care of your liabilities. And also one more thing, if I have to pay my interest in this particular period, when the quarter is getting over, and the money is going to come after 6 months, after 9 months, then I will have to take some debts, some more loans to pay that earlier loan. That should not happen. The cash flow should be even and should be having a proper timing so that I am in a position to pay my long-term liabilities. It also tells me whether my balance sheet is good or bad. Okay. Leverage ratios. Leverage is used by everyone. CapEx is done. 5, 10, 15% must be invested, and some companies go for high leverage ratio. Here is an example of company investing rupees 50 lakhs. Makes a profit of 10%, 5 lakhs. Pays a tax of 1 lakh, 20%. So net profit is 5 minus 1, 4 lakhs. So return on investment, return on equity, sorry, is 4 lakh divided by 50 lakhs. Because the profit is 4 lakhs divided by the investment 50 lakhs in 200 will give me 8%. There is a company B. It goes for 50 lakhs investment and 50 lakh borrowings. So total investment is now 100 lakhs. Company makes the same profit of 10%. So the profit is 10 lakhs. It gives the tax interest on loan for 8%. Now this interest on loan is a very important factor. If the interest on loan 8%, here it is less than the profit 10%. So I am okay. But if the interest on loan is higher than the earnings percentage, then you will always be in a perpetual debt. तो ये हमेशा important thing है कि आप loan लेते हो, उस पे interest भरते हो, that should be lesser than your profit. Because if it is more than the profit percentage, you will be in a perpetual debt kind of situation. Many companies are in that kind of situation that they take one debt to pay the other debt. So profit after interest 10 minus 4 is 6 lakhs. And I'm paying a tax of 20%, 1.2 lakhs. So my net earnings is, here it was 4 lakhs, here it is 4.8 lakhs. So 4.8 lakhs on the 50 lakhs of my investment, because I'm looking at ROE and not ROCE. So on 4.8 on 50 is 9.6. So if you see ROE, return on equity, here it is 8% and here it is 9.6%. Definitely company B is doing better than company A. Leverage is not bad, but if your loan percentage, here it is, interest percentage on loan and the ROE. If your loan, you are paying more interest, then you will have a definite problem. You should have a proper balance between your debt and the investment. In many capex heavy industry, manufacturing companies, big malls, cement industry, mining companies, steel industry, real estate and infra companies. This becomes a major issue. They start the project, they start with some debt levels, and the project gets delayed, and the debt keeps on amassing. In case of other sectors like banks, financial services, IT, commerce, e-commerce, networking base, their immediate money is coming, cash rich. They don't have to wait. Account receivables is fast. They have good reserves, and therefore the debt is always less. So there is always a financial risk associated with a company when they take a debt. There is always a financial risk. So your debt should be such that you are able to pay your interest part from the cash flows which you are earning. If you are not in a position to pay, definitely you have a problem at hand. So we'll be seeing these ratios. Interest coverage ratios, debt to equity, debt to asset, debt to capital ratio, debt to EBITDA, and financial leverage in general. Interest coverage is, I am earning money. Is my money sufficient enough to pay the interest? How easily I am able to pay my interest? It is also known as times, number of times interest earned. So if you are earning much more than the interest you are paying, then there is no issue at all. So earning before interest and tax divide by the interest. So if this numerator is much more than the denominator, then there is no problem at all. Everyone uses this particular ratio to find out whether a particular company is doing well. Normally anything above 4, 5 is good. An example here is, if I'm a numerator EBIT of 40 lakhs and the denominator is something like investment, I have taken some loans, I'm paying an interest of 10 lakhs. So 40 upon 10 is nothing but ICR, interest coverage ratio, is 4. That's good enough. A company which is a different company, B, 40 lakhs EBIT, but the interest is high. Okay, so 40 upon 20 is 2. Definitely company A, interest coverage is much better than company B, because company A is having sufficient money to pay the interest. Here are the ICR figures of some companies. CHUL 104, Asian Paints 58, TCS 79. These figures are last year figures. I had no time to change it today because of my laptop problem. Whereas you see the realty companies down 1.13, 1.36, 1.98. Zomato minus. We can see these figures today also. We'll find something similar. So a higher ICR means the burden of debt is low and you are able to pay your money easily. You are having strong fundamentals. A lower ICR, company is not able to pay. Fundamentals are not good enough. The company can go bankruptcy if this situation continues for another 6 months, 1 year, 2 years, depending upon the holding point. If your interest coverage ratio is less than 1, then definitely somewhere you will need money to pay your earlier debt. I know of my company which has done this, kept on taking debt, one after another. Ultimately, they were in deep financial trouble. My past company. So interest coverage, you have to be very careful how much of depreciation is there, how much of amortization is there, because it will ultimately reduce your operating profits, your numerator. Depreciation and amortization, you're not going to pay your money immediately, but still you have to account for it. So many people use this variation in the ICR. They use, instead of EBIT, they use EBIT DA, divided by the interest. So EBITDA is EBIT, earnings before interest and tax, plus D for depreciation and A for amortization. So that was my first ratio. Let us see some charts, some data points. Let us see Tata Steel. Enterprise value to EBITDA, enterprise value to sales. PTOS score is very good. I was not able to see ICR. I don't know why. Oh, here it is. Interest coverage, 10.2. So if you see Tata Steel as a company is paying whatever the interest it is earning 10 times in the cash flow. Let us see the cash flow. So here you are seeing Tata Steel. These figures are telling me, here it is, second row. P is much lesser. Price to book value, not very high. The IV, that is the intrinsic value, is telling me that the share price should have been somewhere near 2957, whereas it is actually 885. So it is having a large margin of safety. It is having a very large margin of safety. The debt is high, no doubt, as I was telling you. But if you see the cash flows, you can see these figures also very positive. And let's see the cash flows. You can see here, operational cash flow is 44,381 crores. And expenses are less than 23 and 10 means 33. So it is still positive. And this is March 22 figures. So if you see, Tata Steel is very solid on the figures. Okay. See the ROCE, 32%. Anything above 15, 17 is good. And here it is exceptionally good. Okay. So there is no issue on the pledging and shareholding point of view. It is a Tata company. Promoters are holding 33%. Pledge is only 1.55%. Because when you take loans on the major capex expenditure, definitely some pledging. Current market price to free cash flow. So this is a good figure to tell me that the company is actually available at a very low score, low price. Petrosky score 9 is supposed to be the highest. Here it is 8. So it is telling me that the company is doing exceptionally well. Okay. Let us see some other company. We can see Hindustan Unilever. See here, interest coverage. Tata was 110, it is 113. Very good, excellent. But here you will find the IV is 870, intrinsic value is 870, whereas the company is at 24. So it is moving at approximately at a P of 65. That is why I keep on saying in my messages that the P of most of the FMCG companies are pretty high, pretty high. Pledging is less, nothing is there. Promoter holding is excellent. Debt to equity ratio is good. So what you're seeing is a company doing much better. You can also have a look at this in this particular trend line also. It gives me a lot of. So let us take some other. Reliance. See the ratios of Reliance. Let us see. You need some subscription. Yes, this week I subscribed to Tijori Finance because there is some information which is not available on others. So you can see your liquidity ratios here and interest coverage is here. So this is 3 years CAGR. It is increasing at 7.4%. 5 years it was negative. So this tells me that the interest coverage is good. The company is able to pay the money from its own financials, okay, from its own cash flows. So here we'll see the cash flow. This is the 2022 figures are not given, so I can't do much. 2021 is bad. So let's see Reliance in screener. Okay. The cash flows were negative. Here you can see. That is why the figures were not available. If you see the intrinsic value of Reliance is 2364 and the current market price is 2391. So there is not much of margin of safety available. Cash flows from operations. You can see here 110 and investment is also 110. Some money has come from some investments earlier done by them. So some money has come from that. That is, you can see proceeds from borrowings. So if you see the cash flow from operations and the expansion or investment activity is nearly about the same. That is why the free cash flow is showing little less. ROCE of Reliance is 10%. Normally ROCE should be above 15-17%. But if you see your last so many years, it has not moved beyond 12%. Okay. So Reliance is having a problem. One of the things which I see is that it has diversified so much that actually it is 4-5 companies, not one company. And when you are looking at only oil as one of the reasons for comparison, we find that other things like Geo and all those retail and now in media also and fashion industry also, they are not able to show individually each one of them. Similarly, if you want to see ITC, ITC is doing much better this year. Okay. You see ITC interest coverage is 346. Very, very, very high. Means unko kuch problem hi nahi hai. Unko aaram se wo, they can do your capex also as well as. But what do you see the intrinsic value? It is 143. And the current price is 293. Means it is just about double. So it is not a very high P, not very high, even though there is no margin of safety because it is already double price, but still the P is telling me it is not very, very high. I'm going to do this now regularly so that you start understanding how to see the stocks. See here, the peer comparison. P of ITC is high. Other cigarette companies are much lower. Current market price to book value, anything above 3 is little high. Here it is 5, it is still high. Let us see the operation. Cash flow is 15,776. Okay. So that was positive, but some financial activity for which they have paid some money, very big, and that is the dividend. Now this dividend is a very big amount they have paid. You can see the dividend is always big in ITC. So the net cash flow is coming little negative, but not much. That is only 43 crores. So that is, they can easily manage it, okay, with their earnings on a month-to-month basis. Let us see ITC in this. Some figures you will get in one particular tool, some figures you will get in the other tool. So it is always better to have a look at the others also. So let's see the financial of ITC. Debt to equity. This is the last 3 years CAGR figures, and March 22 is the third column. Okay, so there is no debt to equity. Interest coverage is always high because debt ही नहीं है तो फिर कहाँ से problem आएगा. So you can see here, it is the third column, 513, 395. It is excellent figures. Compared to the peer groups, the scores, these are the trend line scores. Now ITC is the sector wise, it is in the cigarette manufacturing companies, but definitely even in FMCG and all, they have done pretty well. But that you will not be able to see unless you read the annual reports. There you will be able to see the different sections under which you will be able to see the profit and loss balance sheet for each of those sectors where they are. So let's go back to this. So this is my interest coverage ratio. Now we'll see the debt to equity ratio. Debt is a very important thing. So debt has to be compared with the equity of a company. This is one of the ratios which is used every time you take a decision to buy or not to buy a share. Maximum, you should look at values around 1. Maximum. If the debt is very high, more than 1, D is more than 1, then you should avoid such companies. Because the company should be able to pay from their own money and not further debts. It tells me how much is my total assets and what is the debt level of it. So if my total debt, short term as well as long term, is some X figure, then the denominator has to be such that I am able to pay from my own equity. Equity is nothing but the net worth of a company. That is the current assets minus the current liabilities. This matrix is very important for valuations point of view. Everyone has a look at this matrix. If the D value is greater than 1 or much greater than 1, it is not a good thing. For lenders, for people who buy the shares, you look at D ratio low. Okay. Otherwise, if the D ratio is high, there is a possibility you will be end up in a company which is full of debts. So this is a good scenario. It means that the company debt is less, much less than its equity. It is able to service the debts from its own earnings, from its own cash flows. If D is greater than 1, it means the company is unstable. Anything about 2 plus is not good. If it is very much greater than 1, the company can collapse also. The D ratio should be compared from industry to industry because there are capex industries where you'll find the D ratios high compared to the service industries. Generally, less than equal to 1 or 1.1 or 1.2 is good enough, not more than that. Okay, some people can take a risk at 1.5 levels also, but if you take up to 1.2, it is good enough. If D's ratio is increasing over a period of time, 0.5 से 0.6 हुआ, 8 हुआ, 0.8 हुआ, 1 हुआ, 1.1 हुआ, that means there is some amount of debt which is continuously the company is taking, maybe for expansion, maybe for its own working capital. If it is money is borrowed for running the company, that means it is not a good way of running the company. Let's see the debt of some of the companies. The debt to equity, here you can see. Here it is. ITC, it is 0. Definitely it will be 0. Tata Motors, let us see Tata Motors. Here it is. Quite high because they have taken a lot of loans. Pledging is also not very high. Patriotic score is low, very low rather. Fundamentally, Tata Motors is not so good. Fundamentally, Tata Motors is not so good. Tata Steel, debt to equity 0.66, much better placed. Pledge is little bit, that is okay, because when you go for some big investments, you have to pledge some of your things, some of your assets. I was seeing in the group comparison between Tata Motors and Mahindra. Debt to equity of Mahindra is also 1.65 because of the expansions they go for. Okay. Pledge is less good. Patriotic score is very good. So compared to Tata Motors, it is much, much better. Okay. Debt to equity is also slightly high. Let us see Maruti. Very, very low debt to equity. No pledging. But when we see this score, we feel that the company Maruti is much better. But let us see the intrinsic value, 2000. And here it is 8,400. So the price of the stock is 66. So the stock has already risen to such levels that the getting any major gains is, see the ROC and ROE, less than 15, both of them. And then if I see the returns in this period, here you can see sales has increased this year. Last 3 years, it was less than 10. Profits are negative. This year, it is positive. Last 12 months, it is positive because you can see the base is very low. Okay. The stock price is just moved up. Return on equity is also not so good. See your profit and loss annual statements. The EPS is doing well. Operating margin is less than 10. You can see here this 13, 10, 8, 6, less than 10. Net profits in percentage point, it is not given here. Okay, the figures are here. Debt to equity is nothing. Interest coverage is good. See the net profit. 4.26%. March 22. March 21, 6. March 27. So if you see, there is hardly in fact, if you see last from 2017 onwards or 16 onwards, the profits are decreasing. That is why the last 3 year profits are showing minus 21 and last 5 years are showing minus 70. So what has happened? The stock has already gone up too much. The sales are not there. The sales are also decreasing. And definitely the company was not seeing much of a movement. Okay. Let us see another ratio, which is debt to assets. So instead of debt to equity, we are looking at the debt to assets. This ratio should be looked in the same industry. You cannot compare across the industry because we are looking at assets. Assets will be different for different industries. And therefore, you should look at in the same industry. And you should compare historical of the same company as well as with the peers in the same company. It tells me how financially my company is. The higher the ratio, the more leverage you are taking on your assets. and therefore the risk level is high. The lower the ratio, you are taking less of a leverage. As an investor, typically the foreign investors will like to see the debt to asset ratio between 0.3 and 0.6. If it is lower, it is better. If it is higher, you will find it, the company will not be able to get the loans so easily. Many will not be able to get more credits. And if they are going to get credits, more loans, they will have to pay higher interest. A very low value of debt to asset also tells me that I'm not managing the company properly. Everything I'm looking is from my own company resources, and I'm not in a position to take advantage of the loans which are available in the market. So that other extreme of a lower one is also not so good. Every company will have the risk, but some amount of debt is important for the company. And if you are in a position to pay your things properly, your credit worthiness will increase, your payment history will be better, and you will be able to get better loans at a proper interest rates. So here is another screener which I have taken. I have continued with the earlier. The last few ones are this debt to equity, price to earnings. Okay. You can add this interest coverage ratio above 5. Okay. So this is a screener where you can use and you can find out where you belong to. Let us see the screener, which I hope I have not changed my screeners. These are my earlier screeners. Okay, let us see this VSA mid-cap strong screener. Okay, it is the same one which I had. Okay, no change here. So let us run this query, and you find with this query, mid-cap companies having a good amount of volume on the market, sales growth is good, return on capital is above 15, debt to equity is 1.5. Let us take 1.2 and see this. I'm getting the same 5 companies. You can see here, Tanla Platforms, Mastec, CDSL, RHI, Magnesita. So these are the companies which are there. Now, if I want to remove this market capitalization, I will remove this. I'm looking at all companies which are above the small caps. I will get better numbers. So here I'm getting 10 companies. The 5 ones will be there. APL Apollo, Gujarat Gas, JSW Steel, All Cargo. So you can, depending upon your thinking, your requirements. Now I mentioned price to earnings less than 40. Now today, if I find, I will make it say less than 60. Little costlier companies I want. So instead of 10, I'm getting now 12 companies. Tube Investment has also joined the list. Deepak Nitrite. So start using these screeners. It will help you to understand whether you are buying the right kind of stocks or not. Let's see, the next ratio is efficiency ratio, or also called as activity ratios. We are talking of the current assets and the current liabilities when we are using these ratios. We want to see how well the company is being managed on a working capital point of view. Activity ratios are also called as efficiency ratios. So let's see them. We'll be studying this ratios. Working capital, we'll see what is it. Inventory turnover, working capital ratio, which is also called as current ratio. Okay. Inventory turnover is nothing but the cost of goods sold divided by the average inventory. When I take average inventory, I mean the inventory at the beginning of the year plus inventory at the end of the year divided by 2. This tells me how fast I'm able to rotate. Okay. That is my cycle of from the beginning till the end, how many days I'm using to turn over. Okay. Here is an example. The cost of goods sold is 6,000. Beginning of the year, the inventory was 900 crores. End of the year, the inventory is 1100 crores. So 2000 divided by 2 will be me 1000 crores. So what is my inventory turnover? 6000 upon 1000 is 6. So I am able to turn in 6 days. Okay. So out of 365 days, divide by 6, it gives me 60.83. Means every 2 months, I am able to churn my inventory. The high efficient business will always have a high inventory turnover. So most of the FMCGs, food business, they will have a very high. Then other businesses where the business takes time to sell, like you have seen the auto industry was not doing so well for last 4-5 years. Working capital, the day-to-day expands the working of the operations of the company. The current assets minus the current liability gives me the working capital. Current assets will include cash, accounts receivables, inventories. This is a big amount, and finished goods. If the finished goods like the car companies were lying unsold, that becomes part of the current assets. Now it is moving fast. Current liabilities are accounts payables and the debts. So CA minus CL will give me the working capital. Working capital tells me how liquid I am, how operational efficiency I am maintaining. It tells me that do I have enough money from my cash flows so that I am able to run my company, meet my financial obligations. So if the CA is greater than CL, it is good, no problem at all. If the CA is less than CL, that means it is a negative working capital. I need money to run my company. So expansion has no possibility at all. I may end up paying interest to the creditors all the time, may end up with a bankruptcy. A very high working capital is not good for a company, as maybe the raw materials is lying, the finished goods are lying, excess of cash is lying, and you are not utilizing it. Similarly, if I divide the current assets, divide by the current liabilities, I get a ratio which is called as a current ratio. There is another ratio which is called as a quick ratio. The quick ratio is the same, the numerator, current assets minus the inventories. That gives me the quick ratio. Current ratio tells me that how well the company is able to pay the obligations. So CR greater than 1 tells me that the current assets are high compared to the current liabilities. So it is good, but too much of high is also not good because I'm not using my assets for my benefit. CR less than 1, current liabilities are greater than CA, meaning my liabilities are high. On a day-to-day basis, I have to borrow something for my requirements. Now, the higher the current ratio, the company's payment of the obligations is good because the short-term assets are good enough to pay for the short-term liabilities. So here is an example. Current asset is 200 lakhs, current liabilities is 100 lakhs. 200 upon 100 is 2 times. So company has 2 times current assets for every 1 unit of current liability. If the working capital ratio is between 1 and 2, that is good enough. Higher than 2 means I am not managing it properly. A lot of business opportunities may be there. I'm not even tapping them. CR in itself will not give you a good idea how good my assets are being utilized. Sometimes we have large inventories. This large inventories, I cannot sell it. If it is semi-product or something, they cannot be easily sold. Sometimes the market is such that even though I have got finished goods, inventory is high, but I'm not able to sell my cars. Market is not there. So that was a scenario some years back. Like in the real estate market, many ready available flats are there, but they are not able to get easily sold. So many times the inventories can define your CA levels. They are not very liquid. Receivables, you can push your people to pay your money, but in the case of inventories, many a times it is not so liquid. Now, an example is the mismatch of the timings. You are having current assets very high compared to your current liabilities. But supposing current liabilities I am supposed to pay in now July or August, but my current assets liquidity money will come 3 months later or 5 months later, and I have to pay in next 1 month or next 2 months. Then my timing is such that my current liabilities are maturing much before the money is going to come in. That is also a problem for the companies. So timing is important. Then we have let us see some of the ratios. So here the current ratios are not given. Let us see here. See your current ratio. This is March 22, March 21. First two columns are CAGR of 3 and 5 years. You can see here, it is actually decreasing. Okay. Quick ratio is telling me it is currently 0% for the last 3 years. So Tata Steel, the current ratio of March 22 is 0.6. March 21 was 0.1. Well, sorry, it was 1. And it is in the range of 0.6 to 1. Only in 2018 it was high. Mahindra and Mahindras. Quite good. Even the quick ratios are good. It is in the ratio of 1.4, 1.3, 1.4, 1.3, around 1.14. Okay. Debt to equity is also less than 1. You can see here. Little bit it has increased, but still it is less than 1, much less than 1. Interest coverage is very good. So fundamentally, Mahindra is a very good company currently. Okay. But if you see your IV and all, let's see what is the Mahindra's. Intrinsic value is 630. The company is priced at 1134. So the stock P is around 22. The ROE and ROC are little low. That is little bad. Then we see the accounts receivables. I'm supposed to get my money back from my debtors. How many times my debtors are able to pay me in the course of the year? So my credit sales divided by the account receivables. Normally we have the cash sales and the credit sales. Cash sales is good for us. Credit sales are not so good for us. So normally a company which is B2C, business to customers, is always having a good kind of cash flows because they get more money in the cash, maximum in a month or 2 months time. Net credit sales is credit sales minus money received from the customers. Accounts receivables, average one is at the beginning of the year plus at the end of the year divided by 2. Many companies, they give this figure every quarterly also, so that we come to know about the position of the accounts receivable. It helps us to understand the company's ability to collect the revenue. Money they owe, they are supposed to get it from the other debtors. The total number of days tells me that how well it is being managed. 1 month, 2 months, maximum 3 months is good, but beyond that, it is not able to get it easily. Cash sales business, the debtors are less. Credit sales, the debtors are always more. This is one of the bottom line we should see. A B2C business will always give me better cash flows than a B2B, which will give me better than the B2G. B2B means business to business, and B2G means business to government. Government cash flows always, it is when it is passed, you will get your money. Till that time, you will have to wait. AR, accounts receivable of 30, 60, up to 90 is good. But beyond that, it becomes a problem. Because what is happening, you are giving your money to your people who is supposed to return it back, but they are earning interest-free loans they are getting. And your money is, you are going to pay some money, some interest for running your company, whereas the money which is supposed to come back is not coming back so easily. I was seeing an interview recently of one of the IT companies, which is a small cap or mid cap, I think so. And the owner was mentioning that he is not able to, the CFO was mentioning that he is not able to get his money back so easily from the clients just now because of the current situation. So how you are able to receive your money back is an important part of your profitability. Because if you don't get it in 9 months' time, then what is happening? You will have to take your running of the business, you'll have to take money at interest, and you'll end up paying interest, whereas you have sufficient funds which are supposed to come back, but they are still not coming back to you. So always compare with your industry levels so that you get a sense what is happening in the industry. If a company's account receivable turnover is better than the company B, then the company A is always a better investment. Here is an example. Sales of 800, account receivables beginning of the year, in the month of end of the year, 70, 90, so average is 160 upon 280. Account receivables turnover ratio is this, so 800 upon 80 is 10. Company B, same kind of scenario. Accounts average is now 160. Credit sales are 280. 2,400, sorry. So 2,400 divided by 160 gives me 15. So definitely here you're able to get a better return. So company A, its receivables is in 10 years. Okay, 10 is the answer, 10 times in a year. So the company will have to do much better for this, for getting the money back. They are not able to get the money back. Somebody from the credit department will have to push the salespeople or the marketing people to get the money back. Whereas the company is receiving, B is receiving 15 times in a year, whereas in the A it was 10 times in a year. So definitely company B account receivables is much better. So in such scenario, if your accounts receivables are much better, you may relax a little bit and try to increase your market share. Try to get the customers of company A into your company B phone. So you may do all these things, relax your credit policies to some extent so that you can increase your market share. So many new companies, when they enter the business, and if they are second or third rank and the market leader is having a tight hold on the market share, then they try to take advantage by relaxing their credit policy so that they end up shifting some of the companies A's customers to your company B. So in terms of the number of days, that figure divided by 365 divided by 10 gives me 36.5 days. Now, if I'm having a credit policy of 30 days, that is 1 month, and my receivables are in 36.5 days. So I am giving 6.5 days extra to my person, okay, the customers from where I'm going to collect the money, from the retailers or from the wholesalers. So company A will have to, what they will have to do, they will have to tighten their credit policy. Whereas in the case of company B, it is 365 upon 15, which is 24 days. And the company B is also having a credit policy of 1 month. Then company B is able to recover the money much earlier. Instead of 30 days, they are getting the money in 24 days. So the company B can easily relax their credit policy so that they can attract the customers, convert the competitors' customers, bring their other customers into their fold, and increase the market share. Okay, so higher account receivable turnover is a good thing. Good quality customers are there. They are able to pay you. You have a sufficient cash for your operations. Normally, we look at such customers, companies as little conservative, because if you are having tough days and if you still hold on to your credit policies, you may lose your customer or you may lose the sales. A credit policy is conservative, you may lose the customers, because some other company will relax the credit policy and will take away your customers. So a company A losing customers are having a very slow growth because of the credit policy will try to improve the sales. When they try to improve the sales, they will relax the accounts receivable period from 2 months to 3 months. And in such case, the accounts receivable turnover will decrease. A low accounts receivable turnover is actually a problem because the company is not able to meet its financials, and it can lose because it will have to take some more loans to run the business. So every now and then the company, depending upon the environment, the market situation, will have to assess, we'll have to see how well the credit policies are working. So account receivable now in days and all is important figure one should look at. Cash conversion cycle, you can see. When you're seeing -13, -16 means people are paying in advance for you to get your thing. Working capital days from 37, 42, 23, 29, decreasing, 15, 11. Okay. Let's go to the next one. Operating efficiency. Okay, it is nothing but output divided by input. So operating efficiency greater than 1 is a good thing. Varies from industry to industry. Less than 1 is not good because your output is less than the inputs. So some of the ratios we look at is asset turnover ratio, fixed assets in big capital industries, equity turnover ratio. Sales to total assets is what we look in the assets turnover ratio. So whatever assets I'm having, what percentage of it I'm converting into sales. If the ratio is extremely low or very high, it will be varying from industry to industry. You'll have to check it out with your industry. If the ratio is low, means high amount of assets are going into converting into sales. Whereas in the case of service industry, low assets are required to convert into sales. So service industry, the asset turnover ratio will always be high, whereas the manufacturing industry, the assets turnover ratio will always be comparatively low. A seasonal company or a cyclical company will have high asset turnover, like metals used to have. Suddenly government put that excise duty and the things have fallen down. So seasonal or cyclical companies will have variation depending upon the season. So an expanding company means you are spending money in capex. That means your denominator assets is going to increase. When the assets is going to increase, your assets turnover ratio will decrease. Company which is reducing its size, downsizing companies. That means I'm selling off some of my assets. That is, my denominator is decreasing, and therefore assets turnover ratio will decrease. Or sorry, it will increase. The denominator is decreasing, the turnover ratio will increase. Many a times we'll see fixed assets is used instead of the total assets. Okay. So when I'm saying fixed assets, we are looking at plant, machineries, properties, all those things. So total sales divided by the fixed assets. Very similar, but only we are looking at the fixed assets. So the example here is saying sales is 6,000 crores and the fixed assets are 3,000 crores. Then my ratio is double, 2 times. What does it mean? I am selling twice compared to the amount of assets I am consuming, using. So high capital intensive companies will definitely use fat ratios. Low ones will not use this ratio. So you will find service industries will not use these ratios. Sometimes when there is a high capex expenditure, you may find the fat ratio looking improper. Okay. The equity turnover ratio tells me about the company's ability, sales divided by the equity. Sales divided by the equity. Net sales meaning gross sales minus any discounts you are doing. So example is the sale of 6,000 crores and the average total equity is 3,000 crores. The denominator is 3,000 crores. Then my turnover is 2 times. That means my sales to equity is 2 times. So every 1 rupee investment of a shareholder, I am able to generate sales of ₹2. So equity turnover ratio will depend upon your capital intensive is the industry. Manufacturing companies will always have equity turnover less because they have a high capex capital expenditure. Service industry will always have high equity turnover ratio. So don't compare across the industries. You will have to compare within the industry and the peers. A company wants to increase the equity turnover, will reduce the debts. All right, will increase the percentage in the capital structure and the turnover will reduce. If the debt burden increases, finance interest cost will also increase. This is a very common thing because you are going to increase your debt. Definitely you will be ending up. This is the additional, some other things I've added in my query. Valuation ratios we'll see next time. I will just show you some of the so here it is return. Now let us see all the ratios for which company it is. Mahindra. So last 3 years, return on assets and all were not so good, but current year it is increasing. You can see here 7.45, 2.6. It has increased. 0.7, 3.8. 2019 was good, and then once again 2020 is looking good. ROC is improving. Earnings before debit, the depreciation, interest, and tax interest and tax, profit before tax, annual margin, profit margins, net profit, asset turnover. Okay, so you can see the ratio. Then quick ratios, then valuation ratios, debt to equity, interest coverage ratios. You can go through various companies when you make your selection. Or if you are not so strong on the ratios, what you do is make a dashboard of various ratios and see that whether you are picking up the right ones. So screener, you can easily do it. I'm not a member of this, subscribed, I'm not subscribed, but looking at these ratios, you can easily, you can change your, edit your ratios and add what you want. Okay, click on edit here. I added these ratios. Okay, if you want to remove something, what you have to do, you'll have to remove some ratios from the up and tick mark on this, and then you'll be able to see those ratios. So it is important that you start using your fundamental ratios, because if you use them, then only you'll be in a position to take proper decisions. Okay. Let us see Tata Power. I'm not taking the IT companies because most of the IT companies will not have these ratios of working capital along, because they are managed well and they have free cash flow, lot of cash flow available operations point of view. So here is Tata Power, manufacturing company. Interest coverage is pretty low. You can see 1.70. Intrinsic value is 80. It is at high price, 220. The stock P is high. ROC is low. You can see that. Patriotic score is reasonably well. Above 6.5, it is good enough. Free cash flow is good. So money is coming in very regularly. Book value is high. It is costly one. Interest coverage is low. That is what I mentioned also. This is the peer comparison in the same power industry. But when you compare this with the others like Adani Green, Adani Transmission, you'll see the PE of Adani Green and Transmission 235, 700, quite high, very, very high. Whereas Adani Power is much low comparatively. This is the current year earnings, which are seen better than the previous years. Operational cash flow is there. The net is negative. Okay, the cash flow from operations is positive, but some investment activity has happened. That is why you can see 6250. Fixed asset purchase. A very high investment activity has happened. In last 4 consecutive years, they are doing addition in the power. If I remember, some 75,000 crores they are adding up. Okay, recently I mentioned this. So you can see here, last few years continuously there is, and this year March 22, fixed assets purchase is something like 14,000 crores. So when this such figures are, capex figures are happening, the company is definitely adding a lot of money. I mean, lot of. You can see your conversion cycle has increased. Okay, okay. So पहले थोड़ा कम था, 38, 40, 41 पे था, अभी 55, 58, 51 पे है. Last 3 years it is increasing. Means it is taking more time to get the money back, or from the start to the end, it is taking at least 51 days to get your money. So that is Tata Power. Let us see Reliance. Reliance is not a very good example because it is having so many industries, will not be able to see. Some cement company. Let's see ACC, reasonable stock P. Intrinsic value is 1596. The stock is at 2169. High, but not very, very high. Debt to equity is 0.01. PEG is not very high. It should be less than 2 or less than 3 maximum. 2 tak hai, achhi baat hai. Profit growth is minus, negative this year. Okay, sales. So let's see the profit and the sales. The sales are increasing. Last 3 years it was less. Current profit is less, negative, because the company is not doing so well this year. 1 year, the stock price has increased only by 6%. Let's see the ratios. Cash flow is positive. Net cash flow is also positive. Conversion cycle, not much of sales are happening, I believe, just now. Data days is less. Jada business nahi ho raha hai. ROC is little better. It is improving. The borrowings are not much. Okay, it is not increasing so much. The market leader, Ultratech. Stock P is relatively low. Okay. Most of the cement companies, interest coverage ratio is good. Above 4 is good. Petrosky score above 7, above 5 or 6 is good. It is 7. Current market price to free cash flow, it is good. Slightly costlier. This is the comparison of other cement companies. The 1 year performance, last 12 months. Stock price has gone down. Cash flows are positive. But there is some finance activity. There is a very big amount of repayment of borrowings. You can see they have repaid their borrowings. They are reducing their debt. So that has gone to minus 10,000 crores. So that much money has gone out. And because of which the net cash flow is negative. Okay, currently the net cash flow is negative. But it's not a very big amount. Company will be able to pay it from their cash flows. It is about 1.5 months borrowings. Okay. So if you see 9,000 as this, then approximately 800, 900 crores every month they are having their free cash flows. So definitely they will be able to pay this easily from their monthly borrowings, monthly earnings in cash flows. Sales are pretty good. See here, it is increasing continuously. Expenses also increase because of the cost which is there. Profits, operating profits have increased, but last 3 years from 9 to 11 to 11, it's near about same. Net profits, you can see last 3 years it is increasing. Good, very good. So operational profit margins is 22%, which is currently. Okay, that's good. So Ultratech, if you see the ratios here, net profit is good. You can see it is increasing. This is the current one. See here they are kept March 22 earlier. Screener mein piche tha. So you have to be a little careful when you're looking at it, because when you move from one to another, you may pick up the wrong one. So net profit is increasing. That's a very good sign. Last 3 year CAGR value is also increasing. That's positive. ROC is increasing. Okay, that's good. Last 5 years back, it was 1.1. In last 3 years back, it has increased to 15%, from 1 to 15. That's a good. So what you see is this company is doing well, even though the price is high. Okay. Interest coverage ratio is increasing. That's good. 7.4. Okay. Earlier it was 4.1, then 3.2. Total debt to total equity less than 1. That's a very good figure. That's a good figure. See, total debt to total equity, when this is a negative figure, it means it is good. Just because it is red and negative, don't consider it to be negative. Actually, the debt is increasing from 0.7 to 0.5 to 0.3 to 0.2. So debt ratio is decreasing, but it means that the company is doing better. And the coverage, interest coverage ratio is increasing. That means it is able to easily pay off from their money which they have earned in the cash flows. Okay. Anything else you want to know from me? Next time I'll take valuation ratios. Next time I will be there. The week after that, for 2 weeks, I'm not there. 2 Sundays, I'm not there, basically. So next week I'll be there. I'll take valuation ratios.
Okay.
Anything else you want me to know?
No, Rob, this is good.
Okay. We close
Thank
for the
you.
day. Welcome.
Thank you so much.
Welcome, everyone.